Hello friends, my name is Mark Panazon and I'm a partner and mortgage broker with Mortgage Connection. Here is your monthly market update for the month of September. As always, we're going to talk about my 10 favorite topics. And first up is the Canada 5-year government bond yields. What a roller coaster we've been on. If you take a look at the last few weeks here, really starting around early September, we've had this really nice move down as inflation has come down, and then we have just been ramping up. Now, the good news is we've sort of touched this 200-day moving average and seem to have sort of bounced down from it, very similar to this setup over here. So once you kind of cross over the 200-day moving average, things tend to stay in line with that average. So we've been generally under that average. And so hopefully we're going to continue to see this kind of chop and hopefully move downward. Now, the Canada 5-year bond yield, as a reminder, is where fixed interest rates track. So wherever the bond yield goes, fixed rates in Canada go in the same direction. So we were sort of edging up slightly. We got to a low of about 3.99% 5-year fixed rates, and now we're edging up by that approximate sort of 0.5%, 40 basis points. So now, as you'll see in a few minutes, interest rates are a little bit higher on the fixed rate side. So there's the bonds for you. A number of things factoring in for the bonds. A lot of it actually recently has been the U.S. stuff. U.S. president election, U.S. election with President-elect Trump, as well as the tariff scare. And as of today, he was announcing a 25% tariff. These are bad things for Canada, so the bond market is going to react accordingly. I think that's why we've kind of seen a bit of a move up here, but hopefully it retraces and we figure things out. Those are the bonds. Next up is going to be your variable rates, or the Bank of Canada overnight lending rate. That is the red line. So I'll zoom out here. We kind of know the story. COVID drop, flat rates, inflation increased, rates through the roof. And then we had that nice long pause as inflation was getting back in line. And now we've had consecutive rate cuts on the downside. So the overnight lending rate is looking actually pretty good. There are going to be other projections coming up here in terms of where the bank goes from here. But in general, we're looking at least another 1% to 1.5% in rate cuts. You can see that these move in unison. So we're in this time of period right now on this cycle where we've just come off this quantitative easing cycle, and now we're getting into quantitative tightening. And so we've flipped over the cycle, and now the trend is going to be down. So this is very similar to the 2008 cycle, the great financial crisis in the US, as well as the 2000 dot-com bubble cycle. Very similar setups where inflation was ramping up. As you can see, inflation is the yellow line here. Inflation was ramping up here, and then the Bank of Canada moved rates up. There's a nice plateau as inflation came back down, and then the rates came tumbling down. Same thing here in 2008. We had inflation kind of starting to chop up, not as aggressive, but it was moving up, and we had a number of rate movements up to tame inflation. We got very low inflation. The bank paused. It sort of kind of moved up a bit more, but the bank was comfortable enough to say, let's cut rates. And they made a huge move from about 4.5% down to 1/4. So about 4% in rate cuts. Good time to be on a variable rate mortgage at that time and this time. And I feel like this cycle is going to be very similar. We've seen inflation pump up. The Bank of Canada made their move up. Inflation has calmed down. We had the nice long pause. And now that we're moving down, that inflation's down to 2%. We actually edged up, but the target is 2% for the Bank of Canada. So I see no reason why the bank won't continue to move rates down, just like it has in these other two cycles. If you look at the Canada monetary policy report that was just published recently after the last Bank of Canada meeting, it's been updated with new numbers here. So you can see the overnight target rate, or overnight lending rate, is 3.75% for December. It's currently 3.75%, and the bank meets December 11th. So there's a good chance, actually there's a 100% chance they're going to cut the rate by another 1/4%, and something like a 30% chance they're going to cut it by 0.5%. So if you have an existing variable rate mortgage, this is fantastic news. If you're thinking about buying a home, you're getting into the market, variable rates are on their way down. So projection here so far is that rates will be cut 1%, so from the current 3.75 down to 2.75 by summer, and then sort of hold from there. lots can happen next year. We have an election coming in Q4 of next year. They're probably going to start running, and a lot of news and noise around the summer. So that'll be really interesting to keep an eye on. If you look at a recent email from Dr. Sherry Cooper, who's the chief economist at Dominion Lending Center, she puts here in one of her emails to us, the overnight policy rate is now at 3.75. It will cut to roughly 2.5% by the middle of next year. So that is a more bullish case. That's an additional 25 basis points cut than what they're projecting here. And if you look at some other bankers here, you can see there's all the big six banks. You can see the policy rate by Q4 of next year, 2.5%, 2.25%, 2% for National Bank and RBC. Scotia is really the only sort of bearish lender here, and then 2.5% for TD Bank. So it's going to be somewhere between the low end of 2% and the high end of 3%. 2.5% seems about right by our own Dr. Sherry Cooper. So if that's the case, you're looking at possibly another 1.25% in rate drops. Great news. If we look at now the interest rates, we can get right to them. So as a whole, for all of our lenders, I'm going to go ahead and select all A lenders. Without doing any kind of sorting, the lowest rate on the market is 4.09. This kind of ranges 4 to 5% if you're just wondering what the general rate environment looks like. And then obviously as we start to sort, Alberta, purchase, let's say insured mortgage, you can kind of get a better idea of maybe some of the popular terms. So 4.24 would be the lowest 5-year fixed rate with less than 20% down. If you had a mortgage with 20% down, the lowest interest rate would be 4.29% for a 5-year fixed. If you had a rental property or 30-year amortization or both, the lowest interest rate is 4.5%. So the down payment and the insurance type does matter. If you look on the variable side for insured mortgages, so again, less than 20% down, the lowest interest rate is 4.95, so about 5%. A lot of lenders at 5%, 5.1 for a variable rate mortgage. If you look at a 20% down deal, you'd be looking at lowest interest rate of 5.25%, and then if you're looking at some kind of rental properties over $1 million or a 30-year M, then you'd be looking at about 5.4 and up from there. So if we're looking at a more basic deal here with a variable rate mortgage, and let's say you're a first-time home buyer, the rate is 5%, 5.1%, 5.15%. Really a lot of lenders at 5.1%. So if that's the current rate and the survey says that interest rates will be down to 2.75, and let's even just use that 2.5% number, that is another 1.25% lower. So if it's 5% today, that's going to be about 3.75% by middle of next year. And if you compare that to all the lowest fixed rates, 4.25 is kind of the lowest. So that's where all the momentum right now is on variable rates. You can take a 4.25 on a 5-year fixed, or you can take a variable that might be around 3.75 to 4.25. So it seems like you're almost just going to break even in that scenario. So I want to bring in our comparison calculator that kind of breaks it down. So you can see here what we're doing is comparing a $500,000 mortgage at the lowest rate on a 5-year fixed of 4.24 with a variable rate mortgage of 5.1%, which is prime minus 0.85. And I'm going to price in 1.5% of rate cuts. So this would be, more in line of that 2.25% overnight rate. So a little bit more on the aggressive side. But even if it's not, I'll take one out and we'll just say it's that 2.5%. The end of the 5-year summary shows you'd still save about $7,700 with a variable rate mortgage. You can see that's illustrated here. The initial interest cost is higher than the fixed rate, but eventually it cuts even after 4 or 5 months, depending when the rate cuts happen, and then you're saving money for the rest of the term. Now, anything happen, nothing's guaranteed. Variable rates could move up, fixed rates could go down. It's hard to say what's going to happen, but at the moment, it's certainly looking like, and it's certainly trending like variable rate is the play right now, finally back into the variable rate mortgages. A couple other key indicators in terms of how rates are going to go. So Canada GDP growth numbers, Q2 is still pretty brutal, 0.5, 0.4 in Q1, basically narrowly escaped a recession. I think that was essentially our soft landing that the Bank of Canada likes to brag about. But these numbers are really pathetic, really bad numbers. Our economy is not growing. We aren't anywhere where we want to feel confident as a country that we're moving product, especially now that the tariffs are coming. We're probably going to move even less product, so that's bad for GDP, and all of this is bad for the economy as a whole. And the other one you want to look at is unemployment rates, which have been creeping up all year. They've kind of now found a bit of a base around 6.5%, but that's still a high number for the bank. If you look at some of the averages here, we got to 7% in 2016, 2015 when that little housing boom. And then we're not going to count COVID, obviously, because that was kind of a one-off scenario. But, it's certainly been trending upwards since about 2022-ish, when we're at 5%, which is more of the historic norm for the unemployment rate. So not good news either. That's going to put pressure on the Bank of Canada to cut rates continually as well. What else do we got for you? We have housing starts. Housing starts have been ticking up, so we're building more homes over the past couple months. These aren't gaudy numbers. 240,000 units a month is not going to cut it. Way back, and I think it was April or February, the government came out with their very ambitious housing plan to build 500,000 homes per year. The closest we got to it was 280. So we're bringing in thousands of people. Everyone's probably heard by now the immigration mess that Canada has, and they've now said that they're going to pull back on immigration, and they're kind of just using a honesty system to have people come forth, these newcomers and folks on temporary visas, to non-permanent residents to come forward, so they can be kicked out of the country. So I don't know if that's going to happen. Not looking good. I think this little tick up here is simply the interest rates have come down. More homes are being built. Cost of borrowing is coming down a little bit. So, maybe we're getting a bit of a bump there, but nothing to shake a stick at. And then home sales, same kind of story. Obviously a big month in October. 43,000 units were completed, which is another 3,000 in the previous month. That for me is just interest rates. We've seen 4 rate cuts in a row. So with those 4 rate cuts, more people are jumping off the sidelines, probably into those variable rate mortgages, and that's why the home sales have ticked up. Couple of things coming up as well. The Bank of Canada schedule is listed here. So for next year, they have the standard 8 meetings a year, January, March, April, June, July, September, October, December, with their monetary policy reports in these meetings here. So it looks like the June, July is probably going to be the end of the rate cutting cycle. So that gives us 1, 2, 3, 4, 5, plus December of this year in rate cut announcements. So that's 6 rate announcements. You do the math. If they cut every rate announcement at least a quarter, that's 1.5% of rate cuts. That puts us right around that 2.25% for the overnight lending rate. They may pause on one, or maybe they end it early in June, but it's looking like that's happening. I want to end on the new mortgage rule changes coming up next month, as I probably won't get my next video until afterwards. So I just did a quick blog here. You can check out my website, markpanazon.com, and click on blog. And it's about the new mortgage rule changes starting December 15th. So I highlight them here. I'm not going to go into great detail, but the big ones are extended amortization periods, not just for first-time home buyers, but for all buyers. So now we'll be able to go to 30 years amortization on insured mortgages. That's less than 20% down. Currently, you can only go to 25 years. So that's going to be a big change for first-time home buyers and just new buyers in general. So that's great. And it's not just on new construction, which was the previous announcement. It's on all homes. So that's fantastic news. As well, the price cap has increased for insured mortgages. So for my Alberta clients, this may not come into play, but the cap will increase from 1 million to 1.5 million. So this is obviously for me directed at Toronto and Vancouver. So those other caps. Now I am licensed in BC. So for all my clients in BC, the Okanagan, Victoria, you're going to be right around there. So what this means is that Typically, if it's over $1 million, then the down payment requirement is 20%. Now that's being pushed to 1.5 million, which means you don't have to put 20% down on 1.5. It can just be that minimum down payment requirement, which, as a reminder, is 5% up to 500,000, and then 10% anything above that. So you can essentially get in on a 1.5 million purchase with like something like 70,000 down instead of 250,000 down. So it's still going to be quite a big mortgage. I'm not sure if that's going to really help anybody, but anyways, my thoughts are there. So feel free to check out this. Hope everyone's having a great day. Overall sentiment is that rates are going to continue to come down, which is a great thing. Lots of uncertainty with these new tariff threats that are happening by President Biden. Keep in mind, he doesn't get into office until the new year, so it could just be noise for the time being. Bond markets reacting accordingly. If you're in the market for a home in the next 90 days, I don't think this narrative is going to change of variable rates coming down, so that's what I'm going to be recommending. If you're a little bit more risk adverse and you don't like the idea of choosing a variable rate mortgage, even though I think the evidence is pretty strong that this cycle is not going to stop here. We're coming down. We're not going to come down to COVID rates here, but we're going to be coming down somewhere in that 2.5% range. So there's more rate cuts to happen. And with the stickiness of the bond yields right now with the U.S. news, rates are going up on the fixed side. So anyways, those are my 2 cents. You know where to reach me if you have any questions. Have yourselves a great night.